Today, the Reserve Governor and the board met and they've kept interest rates on hold for the April board meeting. That's kept the cash rate at 2.25%. Now, why have they kept the rate on hold? Well, the reasons come down to they're probably seeing early signs of the economy actually starting to pick up. And those early signs are around business spending. Now, that business spending has seen an uplift in the first half of this year, or the first quarter of this year. And in addition to that, they're also seeing job ad growth. So yes, our unemployment has trickled up higher, but they're actually sort of saying, you know what, there's a lot more jobs coming into the marketplace, which says good, businesses spending, they're investing, and that's going to see that job numbers hopefully continue to improve. It's still not at a satisfactory level. If we look at overall current growth, around that sort of 2.5 to 2.75, it's under where we need to be. So I do suspect that we will see a rate cut, and that may be coming as early as next month. But if we do see a real uplift in the next month's data, we might actually see that rate cut not occurring. Now, that's a big call. I'm still waiting on probably one more cut because generally the sentiment is still struggling. The other positive things as to why they've kept interest rates on hold is around retail spending. So the retail spending numbers are up in January, and that's showing some positive signs that consumers are out there spending. And the other big news story, which is the one I've been harping on, and this is the reason why I didn't think we'd go so aggressive on rates, is we're actually seeing a property surge. So the property market is in good hands in terms of what we're seeing: low credit, we're seeing a lot more construction and loan approvals coming through, and with the planning approvals coming through, we're still at record high levels, although the February numbers were slightly off, but in terms of the trend numbers, they're significant. So we are going to see that sort of transition from those trade workers moving into the property space away from the mining jobs that they were doing, and we're going to see that sort of construction-led recovery that the Reserve Bank was looking for. They'd still like to see general business get into the action and start to invest in, new buildings or in their people or in expansion, and that will obviously help to drive the economy forward. So at this point, we're seeing rates on hold, probably only more as a time in the market as opposed to when we're going to see those rates to drop. There's two other important messages I want to leave with this rate announcement video. The first one is there was a great 3-part documentary series on ABC this past month, and that was on making Australia great inside our longest boom. It's recommended viewing for all Australians to get an understanding and an appreciation of how the economy works on a macro level. So we've enjoyed over 23 years of positive economic growth. We got through the GFC. There's some great insight from the commentator and presenter of that show, and I thoroughly recommend it. Should be compulsory viewing for everyone. So what I've done is I've linked into iView, and you'll be able to link to the iView, get that, and please watch it. If you're interested in how all this sort of pieces of the jigsaw puzzle come together, it is definitely fundamental viewing. I thoroughly enjoyed it. In addition to that, I actually want to talk about the property market, okay? And in particular, I want to talk about the Sydney property market. It's becoming very clear to me that we're now starting to enter what I would consider an stretched price point in that Sydney market. The fundamentals just aren't quite right anymore in terms of the affordability. So for anyone who's thinking about investing in the Sydney market, and I hate generalisations because there's still going to be pockets of the market that are going to be okay, but generally speaking, prices have gone too far, and we are going to give away some of those gains. So if you think about it from an investment point of view, do you want to be paying today's prices now and then but paying 2017 and 2018 prices now versus what you can afford? So in other words, imagine if you held the property for 2.5 years and you paid $650,000 for that property now, and then in 2.5 years' time it's worth $650,000. That's 2.5 years of paying interest and not getting any potential return other than the rental income that you may get. So for me, that market's a no-go zone for the novice investor. For those more sophisticated investors who may take a really long-term view and have a 20 or a 30-year view on it, it's obviously not as critical, but I would say there's opportunity cost that's going to be lost by investing in that particular market. So be very careful. Melbourne's not far behind. There are some pockets of the Melbourne market that I also will suspect are going to give up some of their gains. Or in other words, in 2018, 2019, we're going to be paying the same price as what we paid today. So it's about understanding the opportunity and looking at the right types of properties to buy in this market. Anything that has an emotional attachment to it, in other words, a character home, a character unit that has real livability and a high status score against it, the prices are too hot. Owner-occupiers are buying with emotional wallets and they're paying a premium for those assets. So steer clear of those. We can buy them in the downturn. So we'll get them when the market goes through its downward cycle. But I wouldn't be buying those at the moment. So it's an important message. A message to APRA, if you're listening as well, from a lending point of view, don't make macro-prudential changes unless it's to do with the assessment rate. So what I'm saying there is look at assessment rates and say maybe we need to cap how low they can go because that affects borrowing power. So, for those uneducated, basically a lender will look at the assessment and they have an assessment rate and they calculate their borrowing power against that. If the assessment rate is really low, it means the consumer can borrow more. What I don't want to see is those assessment rates drop any further. And in some cases, I actually want to see a cap. In other words, they're too low and some lenders are allowing consumers to borrow too much. We do that type of thing, we're entering into a bubble zone. We're not anywhere near a bubble yet, but those types of activities are going to mean some consumers who are investing in property now are going to lose money, and they're going to lose big money, and they're going to lose opportunity time. So they mightn't see their losses until 5 or 6 years from now, but when they do see those losses, they're going to set themselves back in terms of their prospects of creating a self-funded retirement. So it's time for caution in the property market. Speak to professionals, get advice, understand the fundamentals, and when a marketplace is cooked, we need to move to the next marketplace. Thanks for watching.